So, hey, again, I'm Sidhartha Dash, or Sid Dash from Chartis Research. So we just had a session on industrializing retail finance advice, and now we'll move to area with some linkages to that, but sort of the idea of pricing, modeling structured products. I think there was an interesting theme that was expressed in the previous discussion, which was the idea that you need to simplify, standardize, and package people's goals and objectives. In some ways, structured products do that. In any case, what we're going to discuss today, we're going to discuss this pricing and modeling of structured products, a complex, multidimensional topic. For that, I have Fabio and Katia with me, two experts in the field, who will hopefully illuminate and take you over some of the key issues and dimensions in this space. With that, could you please introduce yourself, Fabio?
Oh, thank you. My name is Fabio Mercurio. I'm a global head of Quant research at Bloomberg.
Katia?
Hello, I'm Katia. Hi, can you hear me? I am a co-founder of Immersive Finance. It is a SaaS solution for delivering quantitative models and risk systems for the crypto space. But prior to this, I have been 20 years at Quant in foreign exchange and worked both at UBS and Citi, where I have seen a fair chunk of structured products on the foreign exchange side.
Thank you. As I said, I can think of no better experts to talk about the challenges and issues of this multidimensional and complex market. The way we have structured today's discussion is that all of us are going to take a very brief, quick snapshot view of our perspectives, and then we're going to dive in to the discussion. And so with that, I'll start very quickly. The universe of retail structured products is complex and varied. It's a market structure with multidimensional pieces. So you have structured notes, you have structured investment products, and structured deposits. It varies globally. Like anything retail, the global regulatory environment is different in the United States, in EU, and in Asia, if you will. And it also varies by the major components. What are people looking for underlying the maturity, the level of protection, returns, payoffs, etc. The estimate of the size is complex. It's a significant market and often overlooked, but the estimates of the size are variable. If you look at the USIPA estimates for around 2018 or so, it was around 500 billion, which is for Europe alone. And then if you look at, there's some estimates from a legal firm like David Polk, looking at 2021, 2022, which is around 3 trillion overall globally. So it's a large, significant, complex market. And with that, I'll turn over to Fabio, your quick impressions, and we'll move on.
Yeah, thank you, Sid. So we can say a lot of things. I mean, so especially when it comes to different asset classes, different modeling challenges, and so on. So it's like, I would say that one of the things that people may want to know is really about the size of the market, as you mentioned. It's still a very, very, very large market. When it comes to interest rate derivatives, we are talking about hundreds of trillions of US dollars. I mean, for millions of contracts. So I mean, the size of the market is still impressive, even after the financial crisis 15 years ago, when we thought like maybe the world of complex derivatives could really be impacted, and it was impacted, but the complexity maybe was shifted towards towards valuation adjustments. It was kind of like interesting. Shift from the market, maybe not trading and pricing complex structural notes that much, but more shifting focus on other challenges like calculating the impact on credit and funding and other things on the valuation of structured products. So Many things could be said. I just say that for now, but I'll be happy also to expand on different asset classes, different modeling challenges, and that are really asset class specific and not already specific.
Katia?
Oh, hello, yes. So from my side, given that I have been 20 years in the market, I can tell you things have changed quite dramatically. When I started UBS and Citi, let's say that the emphasis was very much on the more exotic the structured product offering was better because it could offer tremendous yields. Of course, those were all very complex, so complex that there were not even models for them. The models were quite basic in the way that they were assessed. The systems were primary, like very primitive, I mean. And by that I mean people could come in with an idea for the Asian market, and we as Quant implemented the model very quickly and booked on Excel. Clearly, the world has evolved, especially after the financial crisis. So what we had is a complete understanding of the hidden risks of many of these very, very exotic and complex products, and therefore where the regulator stepped in as well. And that with that regulatory requirements, it curtailed the level of complexity, but yet some of the more exotic products, which still are interesting for the wealth space, they say became more commoditized because the models have increased in sophistication, and so most people adopted similar models, and therefore their valuation and understanding could be agreed upon. And I'd say that, fast forward, we have an environment where you cannot simply just price options and embed them in notes, embed them in structured deposits, but you have to have an entire system that enables you, that it feeds into every aspect of your risk and P&L, especially within banks and within the issuers, because of the regulatory demands behind it and the level of calculations that are required. And I haven't even mentioned the counterparty risk element of that. Sorry, Sid, we cannot hear you.
Sorry. That puts the market evolution into context. And so with that, I wanted to ask my first question to both of you. Now, given that these products are in some ways fundamentally illiquid, how do you handle the illiquidity dimension of that from a pricing and modeling perspective? They, of course, reference liquid markets in, say, FX or in equities and so on. But the packaged product is fundamentally illiquid and and usually perhaps doesn't have a liquid traded price. How do you handle the dimension? First off, Fabio?
Yeah, so that's a fundamental question, right? So it's I think it's the answer is kind of not completely clear from a theoretical point of view, and even less clear from a practical point of view, because all the pricing models that you can think of, they're based on different assumptions, all that. If you add the market completeness and some market imperfections, that you don't have a unique price, you have a range of prices, even from a theoretical point of view. But bottom line is that the underlying market for the underlying asset may be, if that market is very liquid, the whole idea is to use the theoretical principle of replication and say, like, I want to, I don't have a liquid market for the structured note, but I know how to hedge it, hopefully, right? By trading the underlying and maybe the vols of the underlines and things like that. So essentially, you can say that the price of your exotic contract is actually the price of and the cost of your replication. So and clearly depending on the assumptions you're making, your model, how you hedge your structure, the price could be different. That's why different dealers may price same structure, differently. But the idea that something is illiquid is not necessarily a deal breaker if you know how to hedge a structure, because it is well known to dealers that for them what really matters is the possibility of hedging the instrument, because that's what they are charging to their customers as well, essentially the cost of replicating the deal, plus other adjustments that take into account all the uncertainty and charges, including maybe capital charges that they're subject to.
Thank you. And Katia, from a system perspective and overall model perspective as well, but from a systems perspective as well, how does this drive your thinking?
Yes, you imagine, I mean, just to complement what Fabio touched upon, if you imagine that, models are not agreed, but there is a kind of a range of them. The key aspect is whether for the trader that is running the risk behind the exotic option, if they can actually explain their P&L with the risk that they experience. So, and this is where FRTB and many of the regulators, regulatory requirements are interesting because they enable you to historically justify that approach and your own modeling. And of course, if you cannot, then your capital charges are higher, and hence your pricing will be different than another participant. So clearly, having the closer that you can get to how the market in true fashion behaves, the tighter your prices will be. Then on the aspect of the counterparty risk is also very interesting because if you're doing an issuance on a wholesale market, and all the XVA charges, as we call them, will play a role in that. And if you really want to go down the system route, is the approach that you can no longer have your pricing system in isolation to your risk system, in isolation to your regulatory system, which reports to the regulators your risks or your capital charges and so on. It all has to be an integrated approach. So both from the idea generation principle to the idea of where you to sort of book and value the trade for clients.
And sort of taking off from there, there's been a bit of a regime shift in interest rates and current market volatility after a very long period of very, very low volatility and very, very low interest rates. We've now started to move to a different regime, it appears, if you will. Do you think that will change the environment for structured products generally, structured notes specifically, or do you think that we will continue to see a roughly similar market structure? Fabio?
Well, whenever you have an inverted yield curve like you have now, I mean, there could be chances to invest in steepeners. So essentially, placing bets on the difference between long-term rates and short-term rates. I mean, those kind of bets have been very popular in different zones. I mean, globally, and they're still quite popular, and even in a new software world, so post-LIBOR world. And I think it could be even more popular now. I mean, I don't have a last minute understanding. I mean, of the market size for those, but definitely, given that you can see a really 50-year swap rates being lower than maybe 10-year swap rates, there is a chance of really placing a bet and betting really on the fact that spread will definitely increase because it's kind of maybe a natural that very long-term rates are lower than short-term rates, and so this is something that can impact the structural markets when it comes to interest rates for sure. But I mean, maybe it's not part of your question, but I think the major impact is really about LIBOR transition. There was really a major change in interest rate world, and so with major restructuring of deals and. So anything that was LIBOR based became RFR, so based on the daily compounding of some overnight rate, not only for SOFR, so for the US D world, but also in other jurisdictions. And so those are the main challenges that we need to face now also as Quant, right? So basically transitioning away from LIBOR. Basically, we know that we have 1 month and a half before LIBOR is discontinued for good in the US as well, and so the main challenge there is really to migrate from the old LIBOR world to the new software-based world. And when essentially you have different vols, different correlations, different type of payoffs. I mean, similar to the old ones, but now based on different rates. So I would say that that's still the main challenge. Also, maybe lack of vanilla data. You can calibrate your pricing models too to price more complex structures.
So do you think that has been a significant challenge from a hedging perspective, but also as a challenge from the retail customers' complexity dimension perspective as well? I mean, it was easy to understand one cluster of interest rates, a more broader set of rates and indexes. Do you think that is a complexity theme from complexity too far from the retail consumers, if you will, and also, of course, the hedging issue?
And then, okay, let, of course, Katia expand on this, but it's I can share like a personal situation, right? So I want, believe it or not, I had to refinance my own mortgage, and I was talking to some expert, from my bank, and he told me like, Fabio, I have no idea what's happening. I have no idea how the interest rate is being calculated, like for maybe the adjustable rate mortgages, because there is this when the fixed rate period expires and then the floating rate kicks in. Before it was kind of like a weird. Clear, right? So it was like 1 year LIBOR plus some given spread. Now we need to do this kind of daily compounded on some past window twice a year, and so even the so-called experts, the people like the brokers in the market, may have a hard time understanding. So you can imagine like retail customers. So that I'm sure, and I wouldn't even be surprised if there was at some point some class actions against like banks because they haven't been transparent or they calculated like installments not correctly, because it is not an easy calculation. I mean, like before it was much more direct. That being said, I'm totally on board with what the alternative reference rate committee decided. It was clear the LIBOR was not sustainable. We had to move to a more reliable index, and definitely SOFR is the right choice. And using this kind of daily compounded rates is also the right choice, because that you want something that is absolutely reliable, easy to calculate, and objective in the first place. You don't want, you want to really limit the chance of market participants to manipulate the rate for their own purposes. Katia, so yeah, I think I'm sure you can expand on this.
I think it's very interesting because you mentioned, this high interest rate environment. Not really. I mean, this should be the right level of interest rates. It's just that we've been we grew up in this sort of, at least my entire career, almost like zero interest rate, which is not natural for markets. And that has actually hidden quite a few anomalies in this space. So first of all, let's say that the 3%, 4%, 5%, a kind of normal level of interest rates. Then, of course, inflation, no. Inflation is scary, because then the interest rate can go to levels that you don't have control of them, right? But let's say first that you have a high interest rate environment. Now, I deal with the short end, so I'm not thinking the short end versus the long end. I'm thinking, hey, the short end offers an opportunity here in 1 year, 2 years. So that means that if depositors could get that money back in terms of the deposit rates in the same way that the lending guys have to pay, it's amazing, because then the opportunity there is that you have much more capital protected type of structures. Yeah. So then that means that you can give up your interest rate yield and buy premium options with that. And if it goes your way, you get you can leverage and enhance the yield. If you're prepared to sort of lose out on the interest side. The high vol environment, especially on FX, for example, not FX, but let's say, I came from a world where FX volatilities were 10%. Now I'm in a world in crypto and digital assets where volatilities are over 100%, average 80%. And commodities apparently is like that as well. In commodity markets, you have very, very high volatilities. Now, what they offer is that if you create projects like double no touches, one touches, you can you pay very little premium for those type of products, which can then be embedded in a structure. What is the challenge, though, for a sort of emerging or alternative market like crypto, apart from regulation, apart from institutional players have to come in for this to become a serious market, is that the lending is quite complex. Where do you deposit? Are you going to deposit with FTX? Who are you going to deposit your money with, right? So whereas you have, but then at the same time, it could be an opportunity for traditional players, because if they have, the correct rating in terms of people paying the deposit and not a huge amount of counterparty risk behind it, and yet, you get the specialism of somebody being able to price these instruments in such a highly volatile environment with, acceptable models, then suddenly that becomes an opportunity. So a lot to evolve, especially on the alternative asset class, the one that I'm in. But I'd say that, like with any market, when markets change, there are opportunities, so long as people can be very transparent about modeling, pricing, visualization, stress testing, and really kind of own the risk of the product, which I think is key.
But you bring up a very interesting point. In these alternative asset classes, commodities is not terribly alternative. I mean, it's fairly reasonably standard in some ways. But if you have 80% volatility, if you have lending issues, which are, you have serious risk of your counterparty during the lending process, or you have challenges where there's market discontinuity, even if your counterparty is going to be around. How do you model this? What are the modeling and pricing challenges, and what are the how do you overcome the fact that if your volatilities go to 100% plus, you're starting to see the limits of many of the classical models, if you will.
Yes, and this is what we tend to sort of research and do a huge amount of work towards. But it is extremely challenging. But I can say as well that, in environments where there is high volatility, usually traders tend to do well. And by that I mean banks and, traditional institutional players, they enjoy market volatility, and perhaps because spreads can be higher as well. The same with interest rates. When interest rates are high, we know the banking desks tend to, apart from maybe wrong way type of hedges or margin calls, as we have, they tend to sort of profit from that approach, right? Although what I would have to say is that obviously in alternative markets, a bigger challenge, apart from everything else, regulation, institutional adoption, is that markets are thin. We're not talking about the depths of the market that, Fabio kind of sees in terms of interest rates and foreign exchanges and equities and so on. The markets are super thin. Yet, because of the low interest rate environment, how many managers, asset managers, fund managers, had to seek yield in alternative ways. And there's opportunities if you're sort of first in the game, right?
Yeah, absolutely. Fabio, from your perspective, what do you see as the key sort of pricing and hedging and modeling challenges for these alternative assets, if you will, and then embedding them in these structured products?
This is something we can discuss, I think, for hours and hours, right? So so in general, like I think, okay, when it comes to there are pricing challenges and hedging challenges, right? So they are related, but they're also different. Pricing means that, okay, so you need to find the right model to price a right structure, right? So it's not that any model is suitable to price anything. You can create a price, but doesn't mean that is a correct one, because you need to be mindful of a lot of things. You need to, of course, given us a class, you want to replicate the best you can the underlying option market, but also you want to consider, for example, the behavior of the model. So if you have a model that implies like that the implied vol in the future tends to flatten out, Whereas in the market, this is not the case. You need to be mindful of that. And you say, okay, for example, use a local volatility model that implies some kind of like a flatter and flatter forward vol. You say, okay, if I use this model to price some structure like a click gate that depends really on the volatility that I see in the future, maybe I'm missing something. So that's why people are using, for example, stochastic volatility model on that. So there are a lot of things that can be said, like on the pricing of specific structure nodes or exotic options on different asset classes. Every single asset class has its own specific challenges, and I'll be happy to expand on that if we have time. But there are also like a lot of unhedgeable sources of risk, unfortunately. Like, so sometimes when you have correlation, this could be very hard to hedge, and especially when you have basket options and spread options, and it's you kind of need to rely maybe on some historical estimate, and I hope that everything goes fine. One recent debate is about funding risk, for example, because with transitioning away from LIBOR, banks may not be having a natural hedge against systemic risk. And so there are questions of what to do really to make sure that you hedge funding risk, for example, in a proper manner. And if you resort to the CDS market, that's not necessarily the best thing to do, because you are kind of hedging credit risk more than funding risk. So so I would say, like, from the pricing point of view, there are many challenges that are actually asset class specific and also payout specific when it comes to hedging. I think the complexity of the market, transformation of the markets, creates still challenges, because some risks are intrinsically unhedgeable, and you can use proxies, but the proxies, just by definitions, are not good in all possible situations and scenarios. I stop here for now.
No, and just a very and Katia, your perspective on this.
No, I think Fabio said it perfectly. So.
Okay, just one sort of as we go into as we sort of look to close out today's conversation, there's another element in terms of a trade in retail structured products, particularly the trade-off between simplicity and hedgeability, if you will. I mean, because some properties, for example, if you provide guarantees, or if you provide cross-product guarantees, so for example, 4 currencies and the maximum returns at the top of them, they're easy to explain, but they're hard to hedge. Do you see that as a challenge in the sense, and how would you handle that in the sense that I think multi-currency products obviously bring in issues of correlation, which I think, as Fabio pointed out, is very difficult to hedge, and there's unhedgeability components. How do you handle the issue of the simplicity versus, from the production point of view, hedgeability and analyzability, if you will?
I'm not sure we have time to answer that, but I think at the end, I think we need to understand what it means to be what we mean by easy. I don't think there is anything easy these days, frankly, because even the simplest structure, something that is a hedge back to back, if you look at what the risk you're facing, sometimes maybe you're exposed to like a counterparty risk, even though maybe the market risk is being hedged, because maybe you have different collateral agreements, no collateral agreement at all. So like, I would say that the first thing I would do really is to redefine the concept of easiness, because I don't think there is anything easy these days. Even the easy structure is not easy at all.
I think that just to complement that before we finalize, a very easy product, as you pointed out, dual currency deposits, right? But it's so beautiful actually to understand in the way that it used to be explained to kind of wealth customers. But there's huge risks in that. And nowadays, I don't think they're even allowed to be called deposits, because you don't get your money back if the currency goes pear-shaped. So there you go. I think it's a minefield to talk about the aspects. So we leave it there.
So with that note, we will conclude. So some key takeaways: structural complexity continues. There's no easy product out there, if you will, and it's critical to have the systems and infrastructure to manage your risks and the overall process, if you will. Thank you, Fabio and Katia. Hopefully,
thank you very much.
Thank you, Sid.
Yeah.
Thank you, everyone. All the best. Have a good day. Bye.
Bye.